Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 20th, 2025. I appreciate you coming to my weekend review podcast. I hope you are having a nice weekend, and I hope you had a good trading week as well. The format for the podcast today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades, all the positions that I had from last week. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the signals were, what the confluences, ideally, of signals were. And then we're going to talk about how I position size based upon the volatility of the current market. We're going to talk about where I'm going to place my emergency stop, where I'm going to place my end of bar stop, where I'm going to place my trailing stop level, how I'm going to take partial profits into strength, and then ultimately how I am going to exit the position. So basically, when I entered, why I entered, and how I am going to manage the trade going forward. I hope this is going to be helpful for you to see how I look at trading, how I look at getting in and managing my swing trades. And if you find something that's helpful or useful of value today, I really would appreciate it if you could hit the thumbs up button. Really helps let YouTube know that there's some valuable content here so they can share it with more people. All right, so let's get this U.S. legal disclaimer out of the way, and then we will get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Well, I'll tell you what. Let us take a look at the first position, which is Shopify. So I did enter Shopify here on the 18th of November at 140.47. So far, it's been a really good trade. But why did I enter here? That's the key. Well, this is a rejection of an order block. The order block is this green area that starts in the past and goes in the future. And let's talk about what an order block is. So an order block happened sometime in the past. So let's go in the past and see where that order block started. And here we go. This is the order block that started on 9/2/2025. So what makes this an order block? The way that I use order blocks, people use them different ways, but the way that I use it, the way that I teach it is what I'm going to share with you now. The first thing you need is a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. So you can see here's our low. Is the bar to the left low is higher? It is. The bar to the right low is higher? It is. So that is now a swing low. So first off, I need to start off with a swing low. Then I need a swing high. A swing high is a high that has a lower high to the left and a lower high to the right. So there you go. Swing low, swing high. The next thing I need is another swing low that is lower than the first swing low. Well, this qualifies. Here's a low with a higher low to the left and a higher low to the right. Okay, so we have a swing low, we have a swing high, we have a lower swing low. Now, the key comes when we have this in place, swing low, swing high, swing low. Now we need to concentrate on this swing high, the first swing high we had. Swing low, swing high, lower swing low. Then in the future, if we go above that swing high, like we did here, you can see this high went above this swing high. Now we have changed market structure to the upside, okay? And you can see once this changed here, swing low, swing high, lower swing low, once it changed, it did take off and go. Now, I'm not a breakout buyer, so I'll show you how I use these order blocks. But as soon as you have a swing low, a swing high, a lower swing low, and then you change market structure to the upside by taking out that first swing high, Now I know exactly where my order block is. My order block is the lowest closing bar prior to market structure change. So the market structure changed here. Once it changes, I go, okay, where's my lowest closing bar prior to market structure? Here it is. And it's the high and the low of this bar. And I bring this into the future. Now, let's take a look at once we change market structure, we ran up here, we ran all the way up here. So in hindsight, when we look back at this, now that we know where this order block is, when we're up here, can we look back and go, smart money was buying this order block? Well, clearly, right? In hindsight, you can see that. Up here, when it was way up here, can I look back and go and make the assumption that smart money was buying here? Well, sure, because for sure it was way lower than it's up here. So the way that I look at order blocks, everyone, is smart money areas. And I don't buy the breakout, but I buy the pullbacks to the smart money area, because the thinking is clearly when we're up here and look back here, this was smart money. If we come back to that smart money area, will it be smart money again? Not necessarily, but in my 30 years of trading, more often than not, it is smart money again. Okay. Even in this example here, swing low, swing high, lower swing low, market structure change. Look here, when it first came back down to this smart money area, that's exactly where it bounced and took off again. Okay. So this is what the current trade that I'm in is based all the way back here from September 2nd. So I bring the smart money area into the future. Okay. And I'm waiting for the price to come back to the smart money area, which it did. And this is when I entered the position on November 18th here. Why? Because it went into the order block and then it closed above it. That is a rejection of the top of the order block. And there's different ways I get into this. I can get into this with rejection of the top of the order block. I can get into it with rejection of the bottom of the order block. I can get into it with the rejection of a major moving average or another key level inside the order block. But this particular trade I took because it rejected the high of the order block. So that is my entry. And I did enter here at 140.47. So let's talk a little bit about entries or position sizing, because really it is the most important part of your trade is how many shares you're going to buy or sell, right? And so let me give you the formula that I use for position sizing. It's based upon two things. It's based upon the value of your trading account, and it's based upon the value of the 2 ATR. Right here you can see average true range 2, 1479. An average true range is just what a particular market is expected to move in any one day. So I times that by 2 to give myself the emergency stop and to figure out how many shares I'm going to trade. So first thing, how much is in my trading account? Well, let's just say I have $100,000. I take 1% of that $100,000, it's 1,000. If I had $200,000, 1% is 2,000. If I had 50,000, 1% is 500, right? Works for any amount. So let's just say hypothetically I have a $100,000 trading account. 100,000 times 1% is $1,000. Okay, so now I take that $1,000 and I divide it by the value of the 2 ATR. The 2 ATR is 1479. So I take 1,000 divided by 1479. It tells me to buy exactly 67.61 shares. So I'm just going to round that up to 68 shares. So based upon the volatility of the market and my account size, this is the proper amount of shares for me to buy. And a lot of people do not use the current market volatility as when they're deciding on how many shares to buy. It's very important because market volatility is very high. You need to buy fewer shares. If it's low, you can buy more shares. Okay. But this formula that I just gave you takes care of everything. It's really nice. Okay. So we rejected the high of the order block. I position sized, taking 1% of my Total capital dividing by the value of the 2 ATR. It tells me how many shares to buy, 68 shares, and I enter. I enter here at 140, or I did enter here at 140.47. Now, the very first thing I need to do after I enter is I take the number of the 2 ATR and I subtract it from my entry price and I place it below. Okay, this is the red line here. This is my emergency stop. So if I have 68 shares and it goes down $14.79 to my emergency stop, how much have I lost? Lost $1,000. I've lost 1% of my account. Not fun, but you can recover from that, right? But the good news is this emergency stop only happens about 5% of the time. It does happen about 5% of the time, but the other 95% of the time, if I have a losing trade, it's not going to be because I hit my emergency stop, which is my maximum loss, the 1%. The other 95% of the time, if I have a losing trade, it will be because it closes below my end of bar stop. And my end of bar stop on this particular trade is simply a close under the bottom of the order block. And you can see that's much closer to my entry point than the emergency stop. So I always place two stops. The emergency stop, 2 ATRs below. If I hit that, I'm going to lose 1% of my account. But again, only 5% of the time it happens. The other 95% of the time, if I have a losing trade, it will be because I close below the low of my stop. And on this particular type of trade, it's a close below the low of the order block. Okay, so once I have my signal, rejection of the high of the order block, I position size correctly. I place my emergency stop 2 ATRs below. End of bar stops a close below the low of the order block. Next thing I need to do is I need to place my 1.5 ATR trailing stop level. So I go up to my 1.5 ATR value. Right now it's 1109. And as soon as I enter the trade, I take my entry price plus the value of the 1.5 and I place it above. And so if I take the trade, when I place my 1.5 ATR trailing stop level above, if it gets to that trailing stop level, now I'm going to tighten up my stop. It's a good principle in trading is if you take a trade and it moves significantly, you want to tighten up your stops. You don't want to give back any profits that you've had, right? And so this is why I placed my 1.5 ATR trailing stop level. Entry price plus the value of the 1.5, this is the orange line. Now, if in the future it gets to my trailing stop level, doesn't mean I necessarily do anything. It just means that now I'm in trailing stop mode. And all the trailing stop mode means is that once I get to trailing stop mode, if I have a close below a previous bar's low in the future, I will exit half of my position. And exiting half of your position has the effect of tightening everything up by half, right? Once we get to trailing stop level, once the trade starts moving nicely, we want to tighten things up. Well, selling half, if you have a close below a previous bar's low, has that exact effect. It tightens everything up by half because you are selling half. Okay? So, everything I've talked about so far, as far as placing your emergency stop, as far as having your end of bar stop, as far as going into trailing stop mode, and selling half in the future if you have a close below previous bar's low. These are all defensive moves. In other words, if the trade goes against me, I need to take action and do something. Okay, that's defensive. But I also play offense in my trading, and I play offense. You need to play both offense and defense, right? So the way that I play offense in my trading, everybody, is that I take a portion of my position off each day if it moves a certain amount from the previous bar's close. So I am currently in this trade, and I'll show you exactly what my profit targets are going to be for Monday and for how much. So all I do is I take the closing price of the day. Right now on Shopify, it's $169.57. So I just take $169.57. And now I look for the value of the 0.45 ATR. The value of the 0.45 ATR right now is $3.19. So I take the closing price, 169.57, plus 319. My first profit target for Monday is 172.50. 172.76. Okay. I'll just put it up here. 172.76. Oh, shoot. $172.76. That is my first profit target for Monday. If it gets there, how much profit am I going to take? I'm going to take 10% of however many shares I went into the day with. Okay. If I went into the day with 50 shares left, five shares, right? 10% of however many shares I went into the day. But I don't just place one profit target, I place three. Okay. So the first profit target was 169, the closing price, 169.57 plus 319 is 172.76, my first profit target. Now I do it two more times, but now I start with the first profit target, 172.76, and I just add it again, 319. Now my second profit target for Monday is 175.95. So we'll put it there. There you go. And again, if I go into the day with 50 shares, put a limit order in the system, 5 shares at the first profit target, 5 shares at the second profit target, and then I always place 3. So now I take my second profit target, 175.95, I add it again, 319, and my third profit target for Monday is 179.14. So we'll put that up there, 179.14. Boom. Now I have my 3 profit targets for Monday. Now, if it goes up decently on Monday, maybe I hit 1 profit target. If it has a really good day, maybe I hit 2. If it has a great day, maybe I hit 3. But I want to take advantage of selling into strength, not the entire position, but I want to take the advantage. If the market's giving me something, I want to take a little something, right? And so you'll see on some of the positions that I show you today how important it was that I took partial profits. And so as it goes up, you're reducing your position size, you're locking in those profits. I'm a huge fan of taking partial profits. All right. So there you go. That is the offensive part of trading. Now, if it goes down on Monday, obviously I'm not going to hit any profit targets. And then the next day I need to start from a lower closing price and do the same thing over. So I do this every day. Yeah, it takes time, right? I have to do it every day, but I'm telling you, it's worth it because it is important. A lot of people great at playing defense in trading. Maybe they're great at playing offense in trading, but you have to do both. Okay? Okay. So that's kind of the basis of why I got in. Let's just do a quick recap. So Shopify, I entered on the 18th of November at 140.47. Why? Because there was an order block from the past. We came back, we rejected the top of the order block. So I entered, I position sized as I showed you earlier. I placed my emergency stop 2 ATRs below. If that hits, I lose 1% on my account. My end of bar stop is a close below the low of the order block. Next thing I do, I put my 1.5 ATR trailing stop level above, and away we go. Let's follow the trade. What happens? So I entered. Next day, it's up. Great. It's a good start to the trade. I hit a profit target, right? The next day, it gaps way open. It gaps up very, very high. I hit 2 profit targets on this day. So you can see I'm already starting to take partial profits as it's moving my way. In addition, on the second day, in addition to having a big gap open and hitting multiple profit targets, I also got to my trailing stop level. Now, I don't do anything. It just means that now I am in trailing stop mode, which means now in the future, if I have a close below a previous bar's low, I'm going to exit half of the position that I have. Well, the next day does go under the previous bar's low, but it closes above. So that keeps me in the trade. The next day up, again, profit target. The next day up, not enough for a profit target. Then we have a couple days where it just kind of goes sideways, not enough for a profit target. Here on the 1st of December, we have our first close below a previous bar's low After reaching trailing stop level, what do? I take off half of the remaining shares that I have, okay? And I did that and locked in a gain on the remaining shares that I had there of 5.83%. Okay, now I still have half the position. So the next day, up profit target. Next day, up profit targets. Then we kind of go sideways here, no profit targets. Next day, big day up, multiple profit targets. Then we go down, Did get one profit target here before it reversed. Another profit target here. Next day, multiple profit targets. And currently, the remaining shares that I have on this particular position doing very nicely on this trade, up 17.21%. And again, this all started because of this order block. And when you look at this big picture, again, what's the order block? Swing low, followed by a swing high, followed by a lower swing low, followed by market structure change. I'm not chasing the market structure change. I'm waiting for a pullback into the smart money area. You can see it happened here. It respected the smart money area. Here again, when I took the trade, clearly it respected the smart money area. So order blocks are a very important part of my trading and my teaching. Learn about them. There are different ways to use them. I try to simplify it as much as possible in my trading and in my lessons, because people can make them very complicated. But for me, they work very, very well. They're high probability trades. And again, the way that I think of them, it was smart money in the past. Is it going to be smart money in the future? Not for sure, but more times than not, right? And it gives you a very well-structured trade to enter the trade on. So I'm very happy with the Shopify trade. So currently up 17.20% on the remaining shares. Okay, Altria. All right, well, you see a green box. That means I entered this trade based upon an order block. And I entered the trade here on the 3rd of November. If we go back in the past, there will be another order block. But this time, Shopify was a rejection of the high of the order block. On this particular day, on the 3rd of November, I took this at 56.63. Why? Because it rejected the bottom of the order block, meaning it went below the low of the order block during the intraday, and then at the end of the day, it closed back in the order block. So that's why I took the trade here at 56.63. So I see the trade, I see the entry, I position size. As we discussed previously, I put my order in, I place my emergency stop now. How far below? 2 ATRs. That's my emergency stop. How much do I lose if it actually were to get down there? 1%, because of the position sizing formula that I gave you. Okay. Where's my end of bar stop? Simply if we close below the low of the order block. You can see how close we are to the bottom of the order block anyway. So if the next day it had closed below the low of the order block, even by a penny, I just simply would have gotten out. Right? That's the key in trading, everybody, is having a good risk to reward ratio, which just means in general that you are when you enter the trade, you want it to be as close as your stop point as possible, so that if you're wrong, you can be wrong small, and if you're right, you can have a potential for a large upside gain. That's the key. And so that's what happened. So I entered here 56.63. I placed my 1.5 ATR trailing stop level above. The next day, it goes up a little, not enough for a profit target. Next day, up again, enough for a profit target. Sideways. Next day, up. Can't remember if this was profit target. Probably pretty close. Next day, down a little. Next day, up. Profit target. And then here, on this day, I hit trailing stop level. Doesn't mean I do anything. It just means now I'm in trailing stop mode. Okay, so after we hit trailing stop mode, here on the 13th, we had our first close below a previous bar's low after reaching trailing stop level. What do? I take off half the position. I locked in half of the position that I had for a gain of 2.02%. Then we moved up here a little bit. Here we moved up significantly, where I took another profit target. Then we moved down Okay, not a lot of profit targets here because we moved down, but remember my end of bar stop is it closed below the low of the order block, so I stay in the trade. Next day up, profit target, no profit targets here. We're just kind of moving up and then we're kind of moving down, but not enough to do anything. And then we move up here, we move up here. Here I get another profit target. I take it into strength. And then over the last 4 days, we've kind of gone down. So the remaining shares that I have on MO up 2.48%. Again, this was a rejection of the bottom of the order block. Next trade is oil. And on this particular trade, you'll really see the advantages of taking those partial profits. So I entered here on the 20th of October at 67.81. Why? Rejection of the top of the order block. Let's go back in time and see where this order block started. This order block started all the way back here, May 30th of 2025. Swing low, swing high, lower swing low, market structure change. As soon as it changes market structure here, I can define my order block, the high and the low, the lowest closing bar before market structure change. The high and the low of this, I bring this into the future. Because when we were all the way up here at $83, and I look back to where my order block was, can I look at it and say, well, smart money was buying here? Clearly they were. Look how far it went up. Clearly smart money was buying here. So this is my smart money area. I bring the smart money area into the future. If we get back to the smart money area, okay, I will consider taking the trade. And you can see it took many, many months for that to happen. But here, on the day that I entered, on the 20th of October at 67.81, it finally did come back to the smart money area. My signal was that it rejected the high of the order block. I got in 67.81. I position size correctly based upon the volatility. I placed my emergency stop 2 ATRs below. If I get there, I would lose 1%. It only happens 5% of the time. My end of bar stop is simply a close below the low of the order block, which again is much closer to my entry price than the emergency stop. So 66.03 is my end of bar stop. Okay, as soon as I enter, I place my 1.5 ATR trailing stop level above, and here we go. Next day, up nicely, right off the bat, up nicely, took some profits into that strength. The next day, up again, big. I hit multiple profit targets on this particular day, and I'm in trailing stop mode already, 2 days into the trade. Next day, up again, huge. Took more profits into that, which you can see based upon where we are now, was very fortunate, right? Taking advantage of the market giving me something, I'm going to take a little something. So, these 3 bars, I took off a large position of my initial position because of all the profit targets. So here I went into trailing stop mode. Now I'm in trailing stop mode. Next day up, profit targets. Then we went down. And then here on the 28th is our first close below a previous bar's low after reaching trailing stop level. What do? I take off half the position. I locked in half the position for for a gain of 4.97%. Okay, after that happens, there were a few days where we went up, where I sold into the strength, then we went down, sold into the strength, sold into the strength, right? And then we've kind of been drifting down, but every time we had an up move, I took those partial profits. In this little segment here, took some profits here. So now the remaining shares that I have, look, we have gone significantly down here. And you can see here on the 16th, I almost got stopped out of the trade, right? Because that's my stop. It would be a close below the low of the order block at 66.03, but it touched it, rejected it. Next day, up big. I took some profits into that, took some more profits into that on Friday. But big picture, look, I entered here when it had the big run. I took advantage of that and sold into that. Now that, look, when all the way down here, if I would have just entered here, placed my emergent or my end of bar stop here, and it would have closed, I would have gotten out. And I would have given up this huge profit by not taking partial profits. But because I do sell into strength, every time I had strength, I sold into it. And so you can kind of see the advantage. So am I up on this trade? Absolutely. I mean, the remaining shares that I have are not up much. They're up 0.38%, but I'm up significantly more on that because of the taking the partial profits and selling half here, going into trailing stop mode. So I'm a huge proponent of taking partial profits. I use it in my trading. I teach it to all my students. But you can see this is a perfect example of why it's important to have rules and to follow those rules and take advantage and take some off when the market gives it to you. So, okay, remaining shares up on USO only up 0.38%. Another example of profit targets being very important. This is FXY. This is the Japanese yen. I bought all the way back here on 11/20/25 at $58.33. Why? We have an order block from the past. We rejected the bottom of the order block. I entered 58.33, position size correctly, placed my emergency stop 2 ATRs below my end of bar stop, simply a close below the low of the order block. I'm almost at the low of the order block anyway, so I have the potential, if I'm wrong, to be wrong very small, which is what you want, right? So as soon as I enter, I place my 1.5 ATR trailing stop level above. Next day takes off like a rocket ship. Great. I got to trailing stop level the very next day, and I took profits off into that strength. The next day down, but it didn't close below previous bar's low. Next day up, took some profits into that. And then here on the 26th is our first day that we have a close below previous bar's low after reaching trailing stop level. What do? I take off half of the remaining shares. Good thing I did that, right? Took off half for a gain of 0.78. Next day up big, where I hit again, I took partial profits into that strength. And then we go down, and now we're up again, another profit target. And then we have 4 days down, no profit targets. Next day, profit target into the strength. Next day, profit target into the strength. Next day down. Next day, profit target into strength. And then look, we fell dramatically on Friday. Okay, so the remaining shares that I have on FXY are actually down a little, 0.03%. But am I still up on the trade? Of course I am. Why? Because I took partial profits into the strength. Make sense? So going forward, if we close below the low of this order block, say Monday, I exit the trade. If it continues to go up, I will take partial profits into the strength. So anyway, I think this is a really good example of showing you why these intraday profit targets on my swing trades are so important to me and so useful. So the remaining shares on FXY down 0.03%. MasterCard. All right, another order block. I don't just trade order blocks, but lately I've had a lot of order blocks, and you can see they worked out quite well. So I took MasterCard here on the 19th of November at 5:30:38. Why? Because we rejected the bottom of the order block. During the day, we were below the order block. We closed back in the order block. I entered 5:30:38. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. I'm so close to the low of the order block anyway, so it's a good risk to reward ratio. I placed my 1.5 ATR trailing stop level above. That's the orange line. Next day starts off good. Sold some into that strength, but we ended up down. But not down enough to where it closed below the low of the order block. If it had, I would have simply gotten out of the trade. Next day, up big, perfect. Next day, down a little. Next day, up, profit target, and I also got to trailing stop level. Then we kind of moved sideways up a little bit for the next couple days, and then here on the 1st of December was our first close below a previous bar's low after reaching trailing stop level. I took off half the position for a gain of 2.51%. Next day up nicely, hit a profit target. Next day up a little bit more, I think a profit target, not sure. Next day we had a reversal. Next day we were up at the high, I took a partial profit. Then we moved down, came into the order block again, but surprise, surprise, this is where it bounced from the order block. Here on this day, I hit 3 profit targets into that strength, which was nice, right? Next day up again, profit target, okay? Then we moved sideways for a few days. And then Friday, up again, I took another profit target into that strength. So the remaining shares that I have on MasterCard up 7.28%. And again, this started with the rejection at the bottom of the order block. Microsoft was another order block from the past. I entered here on the 21st of November at 472.10, rejection of the bottom of the order block. Look how close I am to my end of bar stop. This is key. This is what you really want in your trades. A legitimate rejection of a level, but that level being very close to where your exit point is. Okay, so I entered 472.10, position size, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. I placed my 1.5 ATR trailing stop level above, and away we go. The next day went up a little bit. During the day, it was below my stop. It was below the low of the order block, but it closed back in. That kept me in the trade. The next day, opened, went down way below my stop, but it reversed by the end of the day, closed above the low of the order block, kept me in the trade. Next day up, sold partial profit into that strength. Next day up again, sold another partial profit into that strength, also got to trailing stop mode. Next day down, next day up a little bit, and then here on the 3rd was our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of my position, locked in a gain of 1.33%. Next day, not much. Next day, not much. Next day, up pretty decent where I sold into that strength, a partial profit. Then we moved down, and then here we were getting very close to closing below the low of the order block, but it did hold. Thursday was up nicely, took another profit, partial profit into that. And then Friday was up a little bit, but not enough for a profit target. So the remaining shares that I have on Microsoft up 2.85%. All right, AMD. AMD is a great trade. I talked about this last week when I was talking about the trades that I was looking for. So I entered AMD on Thursday at 201.10. Why? Well, again, from last week's podcast, this is I was mentioning I'm looking at AMD coming to a certain level. Okay, this is a more recent order block. Let's take a look at why. We have a swing low, we have a swing high, we have a lower swing low, and then here we take out that first swing high. So as soon as this happens here, now I know that this is my order block. Lowest closing bar prior to market structure change. I take the high and the low of this order block. I move it into the future. And last week we were up here and I said, look, if we come back down into this order block, this is where I will be interested in getting in the trade. Now, in this example, like so far in the podcast today, I've talked about rejections of the high of the order block or rejections of the low of the order block. I also will take a trade inside the order block if I have a key level inside the order block. Well, the key level inside the order block is this red line. This red line is the 100-day moving average. And what I said last week was, if we go down and we test this 100-day moving average and it gets rejected, that I would potentially take the trade. So here on Wednesday, we closed below the 100-day moving average. So I did not take the trade. But Thursday, we closed back above it. So this is a close under, close over the 100-day moving average, which by itself is a legitimate signal because it rejected the 100. But what's really important here is that it rejected the 100 level, the 100 SMA level inside another key level. So that's what I ultimately my favorite trades are when you have a key level you have a key level that's rejected within a key level. Anywhere in this order block is a key level, but this 100-day moving average, the red line, is residing inside of the order block. So you have a key level within a key level. So that is why I took the trade on Thursday, because it rejected the 100-day moving average. I entered at 201.10. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop on this trade was simply a close back below the 100-day moving average. Okay, so enter 201.10, and then I placed my trailing stop level exactly 1.5 ATRs above my entry, and you can see we had a huge day on Friday, right? And we got right to trailing stop level, and I hit 3 profit targets already on this trade. So I sold into, I placed the 3 profit targets. Well, we hit all 3 of them. Okay, so it's a great start to a trade. The remaining shares that I have on this particular trade are currently up 5.64% already. And the key thing, I took off 3 profit targets into this strength. So going forward now, because I'm in trailing stop level, if I have a close below previous bar's low, I'm going to get out of half. My end of bar stop on this particular trade is simply a close below the 100-day moving average, the red line inside of this order block. But really, these are my favorite trades that I use personally. I mean, this is the trade right here I'm showing you, but also what I teach, right? This is what I teach my students. This is my favorite trade. A key level like a 100-day moving average, 200-day moving average, 250-day moving average, 300-day moving average, 30 RSI inside an existing order block are they're very high probability trades. So remaining shares on AMD up 5.64%. Really good. Okay, so those are the open positions that I have at the moment. I did have a closing trade on TMUS on Friday. And so I entered on TMUS, T-Mobile. I entered here on the 15th of December at 196.20. Why? Well, 2 reasons. The previous day we were under 30 RSI and we closed over the 30 RSI. That by itself is a legitimate trade. Now this did not happen in an order block. Okay, I want to point that out. This did not include an order block, but an under 30 over 30 by itself is legitimate. But on top of that, we had this megaphone trend line from the past. The megaphone trend line is when you have a swing low and then you have another lower swing low and you connect that trend line, that megaphone trend line into the future. And then if price ever gets again to that trend line, generally you will find support, and that's exactly what we did. So and I look for a rejection of the trend line. And so I took the trade here on the 15th because the prior day it went under the trend line, closed back over the trend line. Okay, that's one signal. The second signal, as I mentioned, the previous day was under 30 RSI, over 30 RSI. Okay, so this was my entry here, 196.20. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the trend line or a close below the 30 RSI. I placed my 1.5 ATR trailing stop level above. Next day, moved up, partial profit, right? Sold into that strength, luckily. The next day, up again, partial profit. Next day, we get to trailing stop level. Now, this is a rule that I use and that I teach. If this only happens with under 30 over 30 trades, but if I have an under 30 over 30 trade and it gets to my trailing stop level, but then goes back to my entry, I'm done with the trade. I just wash my hands with the trade and call it a break-even trade. And so that's exactly what happened on Friday. It did get back to my original entry point, so I just exited the trade. But all in all, was it just a flat trade? No. I did make some money on the trade. Why? Again, back to the partial profits. I took partial profits here. I took partial profits here at profitable levels. So it ended up being a profitable trade. Okay. But again, the rule, if I have an under 30, over 30, then it gets to trailing stop level, and then it comes back to my original price, I exit the trade, and that's exactly what I did. So essentially, I exited at break even on this trade. Okay, so I did close this trade out because of that rule. Okay, so those are all the open and closed daily trades. I also trade the weekly bars. So I have weekly trades. Weekly bars close on Friday, right? I make my decision at the close of that bar. So this is the only weekly trade I have. This is UUP. This is the dollar. And I entered the dollar all the way back here on 7/11/25. Why? Well, this is one of those trades that I was just talking about where I have a key level within a key level. I have a major moving average like the 200-week moving average inside an order block. Those are my favorite trades. So I took the trade here on 7/11 at 27.21. Why? Two reasons. Previous bar we closed under the 200. Next bar we closed over. That by itself is a legit trade, okay? But in addition to that, we rejected the high of the order block because the previous bar was in the order block and then we closed above the order block. That's a rejection. So we had a rejection of the 200-week moving average and we had a rejection of the high of the order block. So I got long 27.21. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-week moving average, okay? Then I place my 1.5 ATR trailing stop level above. Next week, took off, hit a profit target. Off to a good start. Next week, down, but it did hold the 200-week moving average. The next week, up very nicely, got to trailing stop level, and I hit multiple profit targets into that strength, which is key, okay? So now I'm in trailing stop level. The next week was down, but didn't close below previous bar's low. Here on the 15th of August, we had our first close below the previous bar's low. After reaching trailing stop level, what do? I took off half the position for a gain of 0.51%. Then for the next month, we really moved sideways. This is a key bar here. This week we went under. I thought, oh, I'm going to have to get out of the trade, but it rallied at the end of the day, end of the week, closed above my stop, so I stayed in the trade. Next week, up, perfect. Took some partial profits into that strength. The next week, nothing. Next week, up strong. I hit multiple profit targets into that week. Couple weeks of consolidation. Next week, up strong. Again, took partial profits into that strength. Couple weeks sideways. Next week, up. Sold some near the top here with the partial profits. And then ever since that, we've kind of come down. So the remaining shares that I have on UUP, doing fine, doing great, up 3.06%, which is a lot on a currency like the dollar. So those are all of my positions. And you see almost every single one of these had to do, one of the reasons I took the trade were order blocks. So, learn order blocks, everybody. They make a huge difference in your trading. You will find yourself in more winning trades than losing trades if you do these correctly. They don't all win, I can promise you that. But over time, order blocks they're such a good setup. Whether you learn it from me or you learn it from someone else, learn them because they will make a big difference in your trading. Okay, so I forgot to mention at the beginning of the podcast that I am going to share with you 6 potential trades for next week. I can't believe I forgot to say that because that's such a big part of the podcast. And I do have these for you, and I'm going to show you these. But before we do this, let's talk a little bit about trader psychology, because trader psychology really is the most important skill in trading. Listen to me, everybody. I've been trading for over 30 years. If you're going to succeed in this business, you need to create a plan and then you need to follow the plan. You can have the best trading plan in the world, but if you don't follow it, what good is it? So the skill in trading is not reading the charts, not that hard. The skill is the ability to execute and to follow your rules. That is the most important. If you want to succeed in trading, that is the most important thing. Laser beam focus, having a set of rules that you follow. Okay? If you don't have rules, then you're going to be susceptible to just making emotional decisions. And emotional decisions in the long run, it doesn't get it done. You have to have a plan, you have to have a process and a structure to a trade that allows you to be to win big occasionally, every once in a while, if you're right. But the key is that if you have a losing trade, you need to have it structured so that the losing trade will be small. And unfortunately, most traders do the opposite. They hold on to losing trades and they get out of winning trades very quickly. It's the opposite, everyone. You need to be very impatient with your losing trades and you need to be very patient with your winning trades, right? That's how I trade. That's what I teach my students. Um, Having a process, you can't control anything, but you can control what the structure of the trade is so that you set it up to where if you're wrong, you can be wrong small. If you're right, you have the potential to be right big. Just like, the AMD trade, the MasterCard trade, the Shopify trade. I didn't know they were going to go up that much. I couldn't control that. All I could control was how many shares when I bought, how many shares I bought, and where my end of bar stop was close to my entry, right? That you can control. But again, back to trader psychology, you can have all this written down and set up perfectly, but you have to follow. So let's talk a little bit about trader psychology and kind of put it into perspective. Okay, so this weekend's podcast quote is from Mark Minervini. Mark Minervini, of course, one of the market wizards, very famous trader, very famous educator. You can follow Mark at Mark Minervini over on X. And let's see what Mark has to say today. Quote of the day: it doesn't matter how much you want something. Wants are weak. Sounds like it's going to be a little tough love here, but it's true. It doesn't matter how much you want something. Wants are weak. The level of success you experience ultimately will be proportionate to how willing you are to do what it takes to succeed. And that willingness will be tested. Hey, we all want to be great traders. We all want to be great athletes. But you have to but like Mark says, wants are weak. Hey, I want to bat 400 at baseball. Well, we all want to bat for. If you're a baseball player, you all want to bat 400. But how are you going to do that? Not just by wanting, you have to put the time and the energy, excuse me, into it. We all want to be great traders, but wanting is not enough, right? It's proportionate to how willing you are to do what it takes to succeed. What does it take to succeed in trading? Well, first of all, you need that you want to have the desire to trading. I'm sure all of you have that. But you have to put in the time and the energy. Then you have to get yourself a process. You have to get yourself a good trading process that takes into account successful trading strategies with good risk to reward ratios, good setups, good confluences of signals. But even if you have that, you learn that perfectly. If you don't execute, follow your rules, it doesn't matter. You have to spend time every day looking at your charts, looking at the levels, position sizing correctly, right? That is what it takes, everybody. To be a successful trader, you have to put in the time, you have to put in the work. You're going to go through drawdowns. You can have a perfect setup that will fail over and over again. And the key is not to give up, to take that next entry if it is legitimate. So I know you want to be a good trader. I know you want to be a successful trader, but you have to put the time in. You have to have the discipline. And if you do that, you have a chance. And the more often you get into the habit of executing your trades perfectly, being patient, and then executing your trades, following it to the T like a laser beam to the letter, the more you do that, the more that will become a habit of following your trading system perfectly. And that is what you are going to need day after day, week after week, month after month, year after year. That is how you will be a successful traders. All these programs on YouTube and everywhere else, get rich quick stuff, it's baloney. It is baloney. You have to put in the work. It's a grind. But if you're willing to put in the work and go through the daily grind and the ups and downs, that's when you can master trading, and that's when you can be successful at it. So, you know, I hate to be a buzzkill, everybody, but it's not easy. That is why most traders lose money. You have to do the opposite of what most traders do, and that is being focused on your process, following the rules, putting in the time, putting in the study, being well rested, having a good lifestyle so that you're sharp at all moments. So I'm going to read it one more time from Mark. It doesn't matter how much you want something. Wants are weak. The level of success you experience ultimately will be proportionate to how willing you are to do what it takes to succeed. And that willingness will be tested. So, are you willing to do what it takes to succeed? If you are, congratulations, that's your first step. Okay, so let's head back over to the charts. I went through my master watch list. I do it every Friday night. I go through my master watch list and I go down through each market and I look for potential trades for the upcoming week, for next week. I look for multiple confluence levels, signals. Now, these are not where they need to be yet. If they were, I would have already potentially have taken the trade. With this particular market that we have right now, I only have 7 of them on the daily time frame, and I have 1 of them on the weekly time frame. And I'm going to go through. I'm going to show you this. So we'll start with the daily time frames first. Now, there are 7 symbols here that potentially could trigger next week, and I always mention this, but it's possible on Monday that all 7 of these could trigger at the same time. Does that mean I would take all 7 positions at one time? No, never, never. I only take 1 position per day, per time frame. Even if I have 7 to choose from, one of those 7 are better than the rest. And what I have to do is I give a quality score to each one of my setups. For instance, if one symbol has 1 signal, it gets a score of 1. If one signal has 2 signals, it gets a score of 2, and so forth. But I don't just look at signals. I have to look at the risk to reward ratio. I have to look at multiple time frames to see what's going on there. Maybe there's something happening on a higher time frame that gives extra support or extra points to the trade. I have to factor in the relative strength of a market. In other words, if the market's down, the general market's down, but this particular trade or this particular market is up on that day, well, it gets an extra point just for that because it is strong on a weekday. So it's a scoring system. It's like a report card. And this is how I trade. This is how I look at things. This is how I teach. And by the way, I do teach a private one-on-one course. I've taught students from all over the world. It's a 20-hour course. We do a video call once a week for 2 hours, and we do it for 10 weeks. And I trade 7 different trading approaches, and this is what I teach my students. I teach them step by step, every single rule of all the different trading approaches that I use. We do a lot of, so I teach the lessons, we go through, I ask a lot of questions, I test my students, we do a lot of simulation trades, but I have taught students from the absolute beginning level all the way up to the hedge fund level and everywhere in between. I love to teach. I love to watch my students succeed, have that aha moment. And the course does cost $2,000, but I promise you, this is an investment in the future. You will have a skill that you can use the rest of your life. So if you're interested in becoming a student of mine, just send me an email. My email is in the link of this YouTube video. And generally, when I do receive replies from potential students, I like to set up an initial video call. It's a free call. It's not a sales call. I just want to learn more about you, your trading challenges, your goals. And then it's a good time for the student to ask me any questions about the format of the course. But I'd love to have you as a student. I will teach you everything that I know, and I promise it's worth every penny. And when you're done, you will be really glad that you took the course. So the one-on-one course is $2,000. I know, that's a substantial investment for a lot of people. I do have an alternative where I do have a really good Udemy online course available for the deep dip buy. The link's in the description. I have sold so many of those courses around the world, and I think it has like a 4.8 star rating on it. But that's a good place to start, is with the Udemy course to learn the deep dip buy. It's somewhere between $30 and $50. But it's 9.5 hours of video. It's it's a very good course. A lot of time on that course, and you're going to learn a lot. So whether you do the one-on-one course with me or start with that video course, I think you'll enjoy both products, and you will learn a lot. So if that's of interest, in the description is the information. So let's start with Boeing here. All right, so on Boeing, we have a red box. That is a red order block. Now, remember, a green order block is a swing low, followed by a swing high, followed by a lower swing low, and then the market goes up and change market structure to the upside. Well, on a bearish order block, it's the opposite, and I'll show you. The opposite here is we have a swing high, followed by a swing low, followed by a higher swing high, and then we break market structure to the downside. So here's the swing high, here's the swing low, here's the higher swing high, and here we break market structure. And when you break market structure to the downside, the highest up closing bar prior to market structure change is your bearish order block. Okay, so the high and the low of this up bar close, running that bearish order block into the future. And you can see, look what happened in the past. We broke structure here. We came back up to the bearish order block, and that was pretty much it, wasn't it? Well, we're getting kind of close to coming back up to the, quote, dumb money area. The green order blocks are the smart money area. The dumb order blocks are the red. The dumb money area is the red order blocks. And you can see people that bought here, you go a month into the future. Was that a smart time for those people to buy? Well, clearly not, right? Well, we're kind of coming back up to that area. All right, so this is what I'm looking for. So the order block that I'm looking at, the high of the order block is 226.19. The low of the order block is 221.47. And there is a key level within the order block. Key levels in the order blocks can be the moving averages, but sometimes there are key levels that I put in. And what I am looking at right now is this level here of 222.50. That's the red line within the bearish order block. So why did I pick that level? I picked that level, everyone, back here on this bar on the 28th of October. So what's important about this bar? On this particular bar, we had what's called a bearish abandoned baby. And a bearish abandoned baby happens when you have a gap up, quickly followed by a gap down. If you have, from one day to the next, if it's very bullish, if it gaps up, but then the next day it immediately gaps down, there's a lot going on under the hood when that happens. Quick changes in sentiment, very bullish to very bearish. So this was an abandoned baby because it gapped up and it gapped down. Was the abandoned baby correct? Oh, 100% it was. But the low of the abandoned baby, and the abandoned baby's here on the 28th of August, the low of this abandoned baby is 2250. So I moved this area into the future because that is a key resistance level. And remember, I'm looking for key levels within key levels. So bearish or bullish. So right now, there's two bearish areas. There's the order block area, and then there's the bearish area of 222.50 that's inside the bearish area. So next week, what I am looking for, and there's multiple ways I could approach this. I could, if we go up and reject the bottom of the order block, meaning we go in the order block but then close below it, that would be a rejection of the order block. If that happens, I could consider getting short right there. My stop would be a close over the 222.50 level, okay? Or maybe we just go up, reject that 22.50 level and close below. That would be another potential short entry for me. What would I do? I'd enter, I position size, I place my emergency stop 2 ATRs above, and then my stop would simply be a close above 222.50. Remember, always need to start off with a good risk to reward ratio. So just to kind of make it simple, I have two options here: rejection of the bottom of the order block 221.43 looks like, or a rejection of the 222.50 level. That's what I'm looking for a potential short on Boeing. Okay, here is CCJ. This is very similar to the setup that's here. I'll take you back to it, but let's go back to AMD. It's very similar, right? We had a swing low, swing high, lower swing low, market structure change. I said I'm waiting for a pullback into the bullish order block and a rejection of the 100, and that's why I took the trade, and it turned out great, right? So far up 5.64% already. But take a look at this, AMD. Now look at CCJ. It's very similar. It's just that CCJ has not got back down to the level yet. So here's our swing low, here's our swing high, here's our lower swing low. We have a market structure change. Now, we do not have a key moving average inside this order block. And so just a rejection of the high of the order block, I don't think I would probably take it because the bottom of the order block is kind of a long ways away. Sometimes these order blocks are tall, sometimes they're not very tall. If they're not very tall, I'm more likely to take a rejection of the high of the order block. If they're tall, kind of like this one, the risk is larger. So I look for key levels inside. Well, the key level for me is 79.80. And why? Well, if we go back here, these three bars create is what is called a V2. A V2 consists of three bars. You have bar one, you have bar two that needs to go under the low of bar one's low, and then you have bar three that closes above bar one's close. Okay, that's a V2. That's a bullish scenario. Was it correct? It was. But the key level on a V2 is this second bar. This is called the washout bar because it goes below bar one's low. Right here, 79.80 is the halfway of the washout bar. This is a key level, okay? So again, looking for key levels within key levels. So I'm looking for a rejection of 79.80 inside the bullish order block, or if it loses that, I could take a rejection of the low of the order block at 77.55. Okay, so next week, if we reject 79.80, I potentially get long there, use that as my end of bar stop, or a close below 77.55. Okay, let's next go to Palantir, PLTR. Okay, this is a very good example here of bearish and bullish order block. Look, here is a bullish order block. I did not take this trade. I know one of my students did. Very happy to see that from this previous order block over here. Swing low, swing high, lower swing low, market structure change, defines the order block, came back into the order block. Was it correct? It certainly was, right? Just another example of how strong these bullish order blocks are. I didn't take it, but I'm glad Steve took it. Congratulations, Steve. But now we have a bearish order block above us. Here's the highest up bar close before market structure change. And as I mentioned with Boeing, this is also an abandoned baby. We gapped up, immediately followed by a gap down. That's very bearish. Was it correct? It certainly was. So the key level that I'm looking at, these just happen to dovetail together, is the bottom of the baby, which is also the bottom of the bearish order block here at 201.60. So next week, if we reject 201.60, meaning we bounce at it, close below or go above it and close below, that would be a potential short for me. Of course, I would position size. I place my emergency stop 2 ATRs above, and then my end of bar stop, if it rejects this 20160, closes below, then just to close back above it would be my stop. Okay, but this is a good example of the bullish order block working, but we're coming into a bearish order block, so that's why I'm looking for a short at this time. Okay, cues. Well, listen, another good example of an order block. Look, we rejected the bottom of the order block. That was the buy signal, was it right? It certainly was. Okay, but we have a bearish order block above us. Okay, the bearish order block high is 630.101, the low is 630.25. Look, when we took that bearish order block into the future, we had that big rally. We got right close to it, and that's where we failed. So is that going to happen again? I don't know. But again, I'm looking for a rejection of 630.30. 630.30 is the bottom of the abandoned baby, just like I showed you on Palantir, right? It's very, very similar. So next week, if we reject the bottom of this bearish abandoned baby, that is why I'm looking for a short, because that just happens to dovetail with the bottom of the bearish order block. So you can see so many times where the bullish order blocks hold and go up, but very often when you get to the bearish order blocks, that's about all it has. So that's why I'm looking for a short, potential short on cues with the rejection of 630.30, combination of the bottom of the order block and the combination of the bottom of the bearish abandoned baby. SPY, again, perfect example of both. We have a bullish order block. When the market sold off, it rejected the bottom of the bullish order block. Was it correct? It certainly was. Then when SPY rallied, where did the rally stop? Inside the bearish order block. All right. So I'm looking for a potential short on the SPY here at the bottom of the top of this bearish order block. 689.70, 682.87 is the low, 689.70 is the high. And you can see 2 weeks ago, we got right there. That's all she wrote. Is that going to be the same moving forward? I don't know. We will see. But I need a rejection at the bottom of the order block, or rejection at the top of the order block for potential short. Or conversely, everybody, if we come back down into the bullish order block, I would look for a long if we rejected this 100-day moving average, the red line, and that 100 at the moment is 662.97. So I wouldn't be surprised if we, head back, we go up a little bit more, but if we come back down, this is another level I'll be looking at. Let's look at TLT. Okay, I was talking to you about bearish, a band of babies. Well, this is a bullish baby. Look here in the green, this is the bullish baby. We gap down, bump. Very next day, we gap up. This is generally very bullish. And you can see after that happened, we did rally for 3 days. Now remember, on a bullish abandoned baby, the high of that baby is the key level. The high of that baby is 87.50. So it going up and then coming back down is not surprising. But what I would be looking for is a close back above 87.50. We're only 4 cents away from it. So if we close back above that the high of the abandoned baby, that would be a potential entry for me there as well. Now, on these particular trades, when I have rejections of tops or bottoms of babies, I do it a little bit different on these trades only. Let's just say Friday this had happened. Let's say we rejected that baby. Okay, here's the high of the baby, 87.50, and let's say it rejected it. It didn't, but I'm just speaking hypothetically here. When this happens, everyone, I make these trades very, very simple. I place a 2 ATR emergency stop below and a 4 ATR profit target above, and that's it. One of the two in the future are going to hit. I'm either going to lose 1% or I'm going to make 2%. Notice how, if I'm right, I'm going to be right twice as much as if I'm wrong, okay? Rejection of a top of a bullish baby is very bullish, actually. And so I'm more likely to make twice as much as I am to lose half as much, right? So anyway, that's what I'm looking for. I'm looking for a rejection of 87.50, or in other words, a close back above 87.50. If that happens and I take the trade, I'll place a 2 ATR stop to the downside and a 4 ATR profit target to the upside. Okay, last on the list is XLE. All right, this one's a really good, nice little potential on this setup. We have an order block here. Why? Because we have a swing low, we have a swing high, we have a lower swing low. We change market structure to the upside. Once we change market structure to the upside, we can define the order block. It's the lowest closing bar before market structure change. The high and the low, this order block goes into the future. And again, remember, ideally, I am looking for major moving averages or major key levels within an order block, key levels within key levels. And here we have two. We have the 250-day moving average, which is at 43.70. We also have the 200-day moving average inside the bullish order block, 43.48. I am looking for a rejection of one of these key moving averages. That would give me a very good risk to reward ratio. It would tell me that the price has rejected a key level within a key level. So next week, if we reject the 250, 43.70, meaning we go below it, close back above it, or close below it, close back above it, that would be an entry. I really like the 200-day moving average. It's right here in the middle of the order block. And so if XLE does go down next week, either reject the 250 or reject the 200-day moving average, that would be a very good high probability trade with a good risk to reward and a defined risk, good risk to reward. So anyway, these are the symbols that I'm looking at for next week. I hope this was helpful for you. If you have any comments or questions, please put them in the comment section. I'll do my best to get back to you as soon as possible. If you found the podcast today helpful, I would appreciate it if you could hit the thumbs up button. I hope you have a good rest of your weekend, everybody. I always like to leave off with, if you could try to go out and do one nice thing for another human being today, wouldn't the world be a better place if we all did one nice thing for another human being every day? And as an extra bonus, if you have it in you and you have the opportunity, if you can do one nice thing for an animal or do a nice thing for an animal whenever you can, that would just make the world a better place too. They appreciate acts of kindness just like we do. So if I can help you with your trading, I would love to teach you. Like I said, I have a 20-hour course. When you're done with that 20-hour course, you will know a lot about trading and you can put it to use. And so love to be your teacher. If it's of interest, just send me an email. But thank you so much, everybody. I hope you have a good rest of your weekend. And God willing, I will see you next week. Take care, everyone. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.